Welcome to Jay's Corner. As people know, healthcare cost concerns as well as long-term care services, these are two important topics that are very, very high up on the list of concerns when people are considering retirement and their financial status. Of course, healthcare cost concerns near and dear to my heart. Today's guest is Lily Vidayaraskul. She is the co-founder of Waterlily. It's an AI tool which is used to help guide people predictively on their need for long-term care services in the future, as well as the financial impact that it can have. Before I misdescribe it or put words into her mouth, let's just get to her interview. Great one. Well, Lily, thank you so much for joining Jay's Corner. I've looked at your site. I've checked it out, know what the idea is. Can't be more excited for today's conversation. Thanks for joining me.
It's fantastic to be here, Jay.
So let's talk about waterlily.com and your own motivations. Briefly speaking, I've seen the intro video and we'll have that shared for everybody. But why don't, in your own words, give us a little bit about you and how you started Waterlily.
Yeah. Absolutely. Thank you again for sharing this, opportunity with me to share my story, which is a lot of folks kind of build companies because there's this really cool idea and I just want to build it. And there's probably a lot of money here for it. For me, it came from personal motivation where we navigated a personal long-term care event in my family that made me dive into the healthcare industry and ultimately build out Waterlily. Prior to that, my career was actually more on the aerospace side. So from 12 to 16, I was essentially recruited by NASA for some of my achievements. Went to college early at 14 for it and ended up, working on the robotics side of NASA at JPL when I was 16. But when I was 16, life just happens. In my case, my aunt, who was a really integral part of our first generation immigrant family, lived under the same roof as us, helped raise me like my second mom. She was diagnosed with terminal stage colon cancer. And what came with that was nearly 3 years of navigating post-chemotherapy, like her frailness, needing help with bathing, dressing, eating, toileting. And it was very financially devastating. But it was also devastating to our relationships, navigating such high stakes health and care decisions with very little time, very little emotional patience that, we haven't spoken to our entire extended side of our family in over a decade. So I wanted to see a different trajectory because the more families I spoke to, I've spoken to hundreds and thousands of advisors at this point, they see the exact same outcomes as well.
I think that's clear, right? Every, survey, and we discussed this before, that I'm part of Alliance for Lifetime Income, which is part of LIMRA now, that, the survey there, which is called PRIP, we just released the second chapter talking about healthcare and extended family, whether that be a parent, their spouse, et cetera, and, the sacrifices that people make. And that can be, and, your extra aspects, so vital here. So that's fairly clear, I think, and if not, can be eye-opening. And sometimes I'm sure you're a super young person, but right, sometimes their first encounter requires a catalyst, and then all of a sudden they're thrown into it. And now all of a sudden they realize, oh, I don't know all these things. So now you've created Waterlily to try to raise the awareness, and, correct me if I'm misspeaking, but why don't we talk about now then, your intent for Waterlily? Who are you trying to reach? Aside from your 13-year-old self, your young Lily.
So when I first started Waterlily, I'll share a little bit of a story here that's interesting, which is I wanted to serve families directly. And very quickly, I learned they were not the right target market for me to, I would say, sell. Our buyer and who we serve are almost two different people because when I interviewed families, they wanted to pay me quite a bit of money to essentially help them solve where I'm navigating long-term care right now. Can you please make it less painful? And there wasn't any software solution I could have architected where I thought I was fundamentally solving their problem, because they had fundamental problems around, I don't have enough money, or I can't figure out how to talk to my mom that I don't have the capacity to do this effectively. And that's when I realized this conversation should happen a lot earlier, probably before the event happens. So if we wanted a band-aid solution, I would solve for families. But because we want to motivate these families decades in advance, um, that's where we think about who have financially aligned incentives to help these families have enough money when they retire, have good relationships when they retire, have that need. And I was able to find the wealth management industry as a result that has the long-term care conversation as a result of being a fiduciary. The really fascinating thing that I saw was that there was little to no adoption of the long-term care conversation as a part of the annual financial plan, or the way that it was adopted wasn't very effective. So that's where I saw there's this massive opportunity to help serve advisors that each serves 100 to 200 households easily.
So now, we have a similar type of pushback. Pushback may be too strong, meaning that when it comes to guaranteed lifetime income, right? We just had another aspect of a financial, integrated financial plan. That the section that you're talking about, the aspect, the cognitive decline, which is one of the specialties of one of the research fellows called Chris High, and yourself, you're sitting with this notion, and that the wealth management industry, your financial advisor in your local hometown, probably aware that these are topics. And how have you found the conversation with the wealth management industry as a whole?
I'll share a little bit of a story. When I first started, I was so compelled. I thought that there was this massive opportunity, and advisors would feel so relieved and excited for me to solve this problem for them, which is when they have a long-term care conversation right now based off zip code calculators, making an average assumption based on national averages. Their client is, one, does not want to have this conversation. Two is, well, those numbers aren't my numbers. So they're not motivated by the additional tools and data that the advisor was providing them previously. And three is that it is a complex topic. There is non-financial aspects associated with it that advisors were too intimidated to broach. And as a result, they looked maybe not as competent as they look in a variety of other financial planning topics that they cover. And so I thought I could help solve for those pain points. And honestly, advisors told me, they initially said, this is such a big pain point, it's so hard. So I just avoid the conversation. And I'm like, well, what if we made it easier for you to have this conversation? And they essentially, I told them, like, is there any way I could personalize, the plan or the long-term care plan unique to your client in this way? And what was fascinating is that they did not understand what I was talking about whatsoever. When I first kind of described that concept, they said, I don't think that's even possible. And so because we knew from first principles how important it was and how high leverage it was for families to know this topic in their 40s to 60s, which is exactly, the target that advisors should be having this conversation. I took a bet with the company, which is, what? I'm going to go ahead and raise some money to do the R&D to show them that the impossible is possible. You can actually predict what your client's unique long-term care needs are going to look like in the future, associate that with costs. So everything is really transparent, and it'll make you look very competent while keeping it as a simplified flow. And it's had really positive reception, since we decided to launch that. So we took 2 years of R&D. And when we launched in the independent channels, we were able to get pretty quick traction with some of the largest like IMOs and BGAs in our space, but also bottoms up from wealth advisors that run their own practice that, saw what we were doing. They wanted to join on. I think our waitlist when I interviewed advisor was 80% conversion onto the waitlist. And then I think 75% conversion into using, the product itself. We've also been incredibly fortunate to receive recognition from Michael Kitz's and the XYPN network. We recently pitched in the Advice Tech competition, which kind of speaks to the network of independent planners that are notorious for being very, very kind of particular and high standard in how they do financial planning as a fiduciary. And we ended up taking both the Judges Award and the Advisor's Choice Award, which are normally reserved for two different companies, because the judges, who are tech experts in the financial planning industry, and the
Right.
advisors, financial planners, are usually two different opinions. But instead, they actually both voted, for us, and so that's why we won both. And so that was really a significant milestone as to the attention that this our industry, our planning industry, now wants to have towards this topic.
So you've talked so far about the professional market. My question now, if I could just slightly shift us, is to the private market, meaning the individuals. So the wealth managers or planners who are educated and understand, how important the topic is, how much of it, from your point of view, is coming from the individual user who is thinking to themselves, hey, I've got a neighbor and they ran out of money, they didn't, have a plan, etc. I need to get going on this. And then calling up their advisor, meaning that, have you get a feel for how much is that of the demand onto the advisor is brought to them from the client, or is it vice versa? Or, what's your sense of that balance?
It's roughly a 50-50 split is what we're seeing, where 50% of the advisors that come in say, I have an active long-term care case, or I'm about to have one. I heard about this tool. Can you make it easier for me? So they know they're about to go through a painful conversation that they can't avoid, and they want to use our platform to help make that less painful for them and for their client navigating this real problem, either on behalf of the client's aging parents or for the client themselves. The other half, though, and then let me know if I'm answering your question directly, is the advisors that had a prior long-term care experience, like case, working on this, where they said, yes, my client brought this up and beforehand, and I didn't feel very confident, so I want to do this better now. So I would say, in both cases, 90% of the time, it was the client that invoked, or kind of acted as a catalyst for starting the long-term care planning conversation.
And I think that is common, right? And without throwing a rock at anybody, right? Which is that, and I'm just using the example just because the parallels are so strong with respect to, I've crazily written this book, but you can understand my point, which is there are other aspects of, that affect total net worth, right? And you have on top the emotional aspect of family relationships. You're talking about the security of lifetime income layer on top of Social Security, and then healthcare cost planning. And now you go, either by catalyst or just by simple aging, you've got other new introductions, loss of cognitive ability, for example, that ultimately comes from the buyer,
Mm-hmm.
meaning that, that as opposed to the person worried about whether or not am I outperforming, 60-40, am I out, et cetera, are my, selections in terms of security selection, is dominates, most of those practices, that it takes this impetus. And we're going to get now, because I'd love for you to share, and I'll turn on the share ability for you to show us actually Waterlily to see what it actually does. And I'm sure I'll have a ton of questions there. We'll run out of time, I'm sure, before you run out of features, for sure.
So what Waterlily does, to set some background, is we help you understand what your future long-term care needs are going to look like and help build out a plan around that. So we break it up into 4 simple steps that the client can do by themselves once they get access through the advisor, or the advisor could walk their client through in real time. So it starts with the 3-minute intake survey.
Okay, can I stop you there for just a second?
Yes.
I have a question. So
Yes.
this platform that you've decided, or the path that you're about to display to us, comes from the end user, the person, the private household, asking
Mm-hmm.
their advisor setting up to this platform. Is that accurate, inaccurate? Correct me if I'm wrong. I just don't want to mislead the
No,
audience.
this
That's
is a
all.
fantastic question. So the advisor has a subscription to our software tool, Waterlily, and so it's a web application.
Okay.
So that advisor could send that invite link to fill out this 3-minute intake survey, or they could do it in real time together, either over Zoom or in the office.
Okay. So,
And
but still, there is this intermediary. You do need to go through a fiduciary person, whoever that party is, in order to get the link by which to take the survey. Is that right? I'm just trying to operationally what people want to know what they actually have to do in order to access stuff. And so
yes.
that's my question.
I'll also even share a little
Okay.
bit of a loophole here, which is the system was designed for financial professionals and care professionals in mind that have this conversation pretty frequently, which that means, which that includes wealth advisors, financial advisors, insurance agents, as well as care providers, usually at like continuous care retirement communities, also have taken on our system. So if you're a consumer and you want access to the system, if you're talking to any of those folks, you should let them know that, hey, I want you to use Waterlily with me. And that's a really nice way to get adoption. And then you don't actually have to pay the software subscription fee. The other loophole, I'll kind of lightly share, I don't know if someone's going to listen in on this, important 15-second snippet, which is if you go to our website, waterlily.com, and you're a consumer, you sign up for, I want access, you could actually mention you're a consumer. And my calendar, I do take on about half a dozen consumers every week and help serve them so that we can understand kind of directly from the source, how can we improve the system? Do they understand if I walk them through it? So that is another way to get access to our system. So if you want to move quickly on that, then yes, you could get direct access. Sure.
Why don't you keep going? Sorry to interrupt. Sorry for the tangent.
It's okay. So from that 3-minute intake survey, we have over 500 million data points of families that we've been following for many decades. So that based on that intake form, we look at the lookalike households for Jane in this case and see what her likelihood of needing care is, the age, the length of that care, and a snapshot of those care needs so that we can give you a quick summary of what her costs will look like in today's dollars. So if you needed long-term care today, we include healthcare inflation and how family members may step in to take care of you and help subsidize that cost. So from there, we step into our care timeline for long-term care, which is, you could go about this a lot of different kind of, I would say, in a branching way, but we make it very simple and kind of in a straight line, which is for your long-term care event, when we predict, 4.5 years for Jane, we'll break that into early care, moderate care, and full care so that you could then choose from early care the appropriate care resources at this phase, which is, aging in an independent living facility or starting to age at home, which majority of folks want to do, and see on the right-hand side how that is associated with cost, how your preference is associated with the cost that we need to solve for. If you want to age at the home, we open up one more set of predictions I think is the most powerful aspect of Waterlily, which is how we predict how much would your spouse, your children, or other family members step in by default to take care of you if you didn't think about this topic. And so this is where if Jane has the means, if her household has the means to pay for, more, then she would normally reduce those hours on her family members, and it'll increase the cost because we're moving those to professionals. If Jane does not have the means, like she barely has enough to kind of go into retirement, that's where you could go the opposite direction, add in some hours for the children or other family members, and then potentially have that conversation so that you're set up with the quality of life that you're hoping for without getting surprised by not having that care in place by family or by professionals because you can't afford it. From there, we help you
Can we go back, actually?
Yes.
Actually, so I told you that, prior to this, I told you that I would have these tangents and ask you some nerdy type questions. So I'm going to proceed for a couple of moments if we could. So over here, if we could go back up a step before you got here, you had some projections, and even prior to this,
Yes.
when you right here. So at here, you've got a timeline which suggested 83. If I remember the prior slide, you said that the care would require at 83. Does this include what other support systems, right? Because studies should say that, financial decision making, declines, far earlier than this, than
Mhm.
83, right? So the question then becomes, and are you able to back from here, or are you not? What is if you
Yeah.
could strike, yeah.
Yep.
So these are and so what you've done here is you've created a database from 50,000 families, and then those 50,000 families kind of ran simulations to think about what the predicted care needs are. Is that accurate? And I'm trying to make it into language that everybody can understand.
Yeah.
So
Yep.
you took your data implied from the medications, if you will, and situation, and created this likelihood, this probability. Is that basically right?
So I'll just add on to that. We do account for whether or not you take prescription medication, but from that 3-minute intake survey, what is also predictive is other medical questions such as like diagnoses, any
Okay.
orthopedic surgeries, injuries, chronic conditions,
Yeah.
sociodemographic information, and financial. All of those are very predictive because we've been tracking all of those variables across, those tens of thousands of families. I think we have a lot more families at this point right now. And we've seen them through several decades up into usually when they pass as well. And so by looking at through our intake survey, who you are, we're looking at the households that have certain attributes that are very similar to you, and being able to grab sort of all those households that look most similar to you and what they already went through, whether or not they had a long-term care event or if they did, and getting a sense of how
Right.
long was that long-term care event, what age did it happen at. So that's why we're able to guide you through predicting what your needs are going to look like. And the only difference here that you can change pretty immediately is like, well, you might decide, we might predict you want to age at the home instead. You're like, well, actually, now that I look at all, the numbers and I've thought about this, I want to change it into independent living. And so that could affect, your future cost because now it's not off of the hourly cost at the home. It is now off of a monthly kind of facility cost in your zip code, if that makes sense.
So I think my point here was that, which we did not get into, but your survey here is taking into account certain specific situation for the particular applicant or the end client, if you will, whoever that, household user is describing their specific information. Your engine then kind of creating some kind of projections across comparisons and data to create this likelihood of requiring long-term care, right? I mean, which are steps that we didn't show here, but I wanted to, get some explanation to put into people's earballs, right? In other words, they need to hear that, because otherwise you're just taking
Mhm.
generic,
Yes. Yeah, absolutely.
generic survey data.
Mhm.
You've actually got something far more granular in the sense of you're asking specific questions about the specific person to get to this percentage. And that's a very important, I mean, I presumed that that's what you were doing here, hopefully, right? So that's kind of why I wanted to drill down on this aspect. Okay, if we could continue, if you would press Jane's care needs, I'm going to have some further questions here as we go here. We've got a few minutes, so why don't you go ahead to the next portion. Okay, so now by early care, moderate care, full care, what is actually being shown here? This is basically, I'm going to take control, kind of home health care first, trying to not be in skilled nursing, full-blown skilled nursing facility care, on that end. And then to the far right, full care. Well, I don't have time for this. I, unfortunately, for better or worse, skilled nursing facility and full-time care is the objective, and then kind of getting a
Mhm.
different care and cost
Mhm.
projection based off
Mhm.
that. Is that accurate?
So what this timeline refers to, it's nearly there in terms of like the logistics. I guess I'll add here. It's actually much more simple to think about actually than that, which is usually when you have a
Okay.
long-term care need, you're older, you're more frail, you start to need help. You usually start to help with one or
Right.
two things at a time. You might need help, with taking a shower at first before you have incontinence issues. And so with the activities that my aunt went through, that many other families that go through long-term care, it is by definition, needing help with bathing, dressing, eating, toileting, incontinence, and transfer getting in and out of bed. And so we predict when you'll start needing help with one or two of those things to start, which is what we call early care. We call those actually self-care activities, as you can see below. That just refers to
Okay.
those
I see.
activities. And then with moderate, so we make a prediction of how long you're going to be needing help with one to two needs. Then we move on to moderate care, which is you're going to need help with three to four of those. Like you're stacking on, like needing kind of your care needs are kind of growing because you might need help now from using toileting to now, oh, you have incontinence issues, etc.
Sure.
And then full care is kind of the really the majority of your care needs, five or six of those out of six kind of fundamental activities that you normally could do independently. Most people know that as nursing home level care. So you go from early care, moderate
Right.
care to nursing home level care is like the natural progression that most folks go through when they have long-term care needs. So that's what we're educating on. And we make a prediction of how
And
long you'll be in care phase as well.
right. The figures you have down there, and we're not going to drill to every last one, those are in today net present value dollars, meaning today's dollars discounted. Is that basically what you've done here?
No, this is actually in future dollars. So we account
In
for.
future dollars. So
Yep. So if we go here
go
really
ahead.
quickly and I'll pause, you'll see that right here, we first account for what does it cost today. So in your zip code, if you want to go to an independent living, we take the average zip code cost, which
Okay.
is about,
Okay.
$4,600. We think it's gonna be about 8 months, is when you'll need how much you'll need that care. But then we account for, well, because you don't need care today, you need care in about 25 years from now. Let's also
I
add
got
in inflation. So you're not surprised by, the amount of money that this will actually cost by the time you need care. So for early care, then this total cost over 8 months is going to be, a little over 130K.
Okay.
And so then if we go to moderate care,
That's totally fine.
yeah. And so if we
Sure.
go to moderate care and full
That,
care,
that, that makes
yeah, it makes more sense, right? Because then by the time you're age, 80, by the time you're age 83, you want to know what is a bucket of money I need by the time I'm age 83 to kind of solve for this. And so that's where we went into, your financing plan here. And so the future dollars for Jane might.
what I like about it. What I like about it is the fact that it's not telling you I need this money today, right? Because the problem if we go back to the first stages that you're talking about here, early stage, middle stage, even the prior one from here, if you
Yes.
went back one, yep, early care, moderate care, full care, these numbers at the bottom then are the dollars that you're projecting at that time in future dollar terms. Is it right?
Yep.
Okay, which is fine. I think that for the people who are numerate, right, they're going to want to know kind of, and too often, as you may know, right, we get these summary statistics out there. We need X dollars for healthcare, et cetera. Well, without a very good explanation about what are we using
Mhm.
for are we using today's constant dollars? Because out in the future, so now I'm going to guess my other question is going to be here is you've got a projection of, okay, we're going to, in Jane's case, the person going to need care at 83.4 years, I think was the
Mhm.
first slide, right? That said, when that would start. What about error? So, right, it's not deterministic, right? So the randomness happens around the projections. What
Mhm.
thought or what is someone to do about it, right? And we'll talk about other sources of randomness, but
Yeah.
you've got a projection. Let's presume every number you have is precise, like exactly right.
Mhm.
We're like, in other words, which can be done for sure. Now, the question then is that you still have outliers, right? Because you still have individuals that
Mm-hmm.
you're projecting with better data, right?
Mm-hmm.
A different way of looking at it than kind of exists in the front of people's minds. Certainly that's clear. Nevertheless, after that, you're still doing this ex ante, right? Meaning, which is, when you get to the event, the person may or may not at 83, maybe it's at 80, maybe it's at 90, for
Absolutely.
this particular instance, right?
Yes,
What
that is
type
correct. So
from asking you about underneath the hood, what have you
yes.
done here to think through that?
That's a fantastic question, which is essentially you're just asking the question of, well, how much should I trust your numbers? How do you like know, like how confident do you feel about me needing care around age 83, or the fact that my care is going to be about 4.5 years and whatnot? So that's the beauty of building out predictive machine learning models, which is you could then do crossroad validation. So that means when we have those 500 million data points, we might actually blind ourselves to about 10% of those households when we run our test
Mm,
to create these algorithms.
mm.
So that means we have no idea what's happening to kind of 10% of that population. So we're going to go ahead and train our algorithm as well as we possibly can on the 90%. So that when it comes to kind of showtime, we then want to run that algorithm that predictive algorithm on what we built on the 10% of the households we never saw before. And we want to see how right were we. And we call that accuracy. So we might know then, a different Jane in our system that we never saw her data before, but we're now kind of making a prediction. But we already know what the algorithm doesn't know, but we know. So we ask the algorithm, hey, so do you think Jane's going to need care at age 80? Yes or no? What about age 81? What about age 82? What about age 83? And so then we do that across sort of like that 10% of the data set that the algorithm never saw before, and we count up the accuracy. Were you 80% accurate? Were you 90% accurate, et cetera? And so every number we show you has a predictive number associated with it, such as, with early care right here, you'll see a question mark associated with it. So each number prediction we made, you click on that question mark and we actually expand it and we show you what was the accuracy metric that we used, how accurate was it, and
I
what were the
see.
top
Okay,
factors. So that's how we explain that, yes, we're not a crystal ball, but this is all about accuracy. And more importantly, how much more
sure.
accurate is it compared to the baseline of national averages today? So you don't want to be compared to a Jane that has heart issues and you don't have heart issues. But if you
Right.
take the national average, it's
No, no,
grabbing everyone that looks nothing like you. So we went ahead and grabbed a data set and we
no
trained.
question. I was just curious. I was absolutely just curious because there's no, and how you would actually then represent that to the users, right? That, like you pointed out, and like I pointed out prior to us hitting record and starting, right? This is better than humans, right? Meaning that learning from that data,
Mhm.
taking out blind spots, taking out anecdotal evidence and biases, et cetera, et cetera. The algorithm will learn over time with that data. And so, like you pointed out, the accuracy then improves. And that's kind of the point of, all of the incredible tools that we have. So
Yeah.
with further ado, why don't we just keep going here? And then you had some projections about what costs look like in terms of how people can use it and
Mhm.
thinking
So
about their projections.
that's correct. So we look at essentially your most likely long-term care event, as you kind of see here. What you can edit is, well, I want to be at the home, or how long do you want to be at home for before you're open to going to facility? And someone might say, the moment that I have incontinence, I don't want to be at the home anymore. Like I think I'd rather get, more assistance or more help. And so once you kind of do that on across those 3 care phases, we know what that future dollar amount is actually going to look like. And so then we're at the financing plan. So her future dollars by the time she's age 83, she should somehow have $2.2 million in the future. And this is where most people look at policies. So most folks there's a lot of misunderstandings around policies. We're probably going to dive into this pretty deeply. And I saw the same misunderstandings. People were selling policies that they didn't quite understand, or clients or families were buying policies that they didn't even quite understand. They just thought, I have a policy now, so that means I'm fully covered. That's not true. So what we did is we built a different set of AI that can upload any policy that you already bought or you're thinking about buying, any type that has some form of long-term care coverage, and the we actually show you the money in and the money out based on the strictest rules within that policy. So you're now not blindsided that it's a 1 million max benefit policy. You're like, oh, that means I'm 50% of the way there because I have $2 million of cost. It's no, there's additional restrictions within that policy, which unfortunately a lot of families get surprised by when they
Sure.
do activate their policy, realizing, oh, there's $100, max daily benefit that, it'll pay out for the home
Right.
and something else. And so we actually base it on the strictest rules. So something that might say a 1 million max benefit might actually only cover $500,000. So we did the math. To your point, we looked directly into the details that really mattered financially for you to think about the investment in an insurance product. But what was really fascinating was that
Just to repeat that here, if we could. So if you have an existing long-term care policy or you have accelerated benefits rider on IUL, GUL, which
that's
are
correct.
index universal life insurance policy for everyday people out there, for our audience, which have these embedded ways to accelerate the death benefit at different rates, rules, restrictions, 100%, 90%, etc., depending on what it is. I guess then from there you've used your most restrictive restraints and then to see what part of the Jane's projections could be met using those contracts. Is that basically, do I have it right?
That is very on point. Where essentially, if Jane went on claim around kind of having two of those six needs that we talked about, then I
Yeah.
just kind of pause the video here. We then want to show, okay, well, it's probably then that you can actually activate this policy to start to pay out for you, but it's not about that max pool where if you start having $500 of need every single day, that the policy is not going to pay out like $500 every day because it has a max benefit of
Right.
$500,000. It is more
Right.
of like, well, are there additional
Sure.
rules in that policy, which they normally do have additional rules around a daily max or a monthly max in some way. So that's where the actual money that's given to you matters, because it's not, might have $500 of need, but the policy is only going to pay out $100. Would it make sense to find a policy that actually pays out maybe $200 or $300 and is not that much more expensive? We call that, what is an ROI on that policy?
So, and I'm very familiar with everything that you've just stated. I guess the question then is, how does that incorporated into your projected needs for Jane in this particular case, right? So you've got some projection of costs or funding
Mhm.
needs, and then we're talking about policies of every different stripe, and we'll
Mhm.
get into state by state and other nuances in a few moments. But you're
Mhm.
talking about, okay, here are some contracts that could possibly be used to defray those costs. How
Mhm.
are you then basically integrating
Yeah.
the two against each other?
That is a really fantastic question. So if we knew prior, we just built out her care plan. We know her needs over 4.5 years, and we also know how much she's going to cost every single day, roughly as well, or every single month. And so when we look at
Right.
the policy dynamics, we model how will that policy actually activate us under James' most likely long-term care scenario that we predicted for her here. So that is what let me go ahead and go here. This is where we go ahead and look at that. Let me go ahead and share my screen here. I'm actually trying to play with the toggles, but when we go ahead and analyze that policy, we look at the strictest rules. Let me see if I can click on the side appropriate right here. You'll see that, I keep clicking on right here. You'll see that what we did is
And
we
just for the
looked at,
people viewing, I see what they're doing. You've basically extracted and analyzed the basic restraints on the basically the guidepost, the goalpost, if you will, on
Mhm.
accessing the benefit amounts at different times, and then comparing it to your projections of the costs of the
Yep,
projected costs at those different times. Um, is
that
that
is.
displayed here on Waterlily?
You
The side by side once you get
Yes. So this is directly from the platform that you'll have access to, is then you'll be able
sure,
to see exactly how this policy would work for Jane in this case, or whoever's sitting in front of us, and the payout in the early care phase, that moderate care phase, that full care
I
phase
see.
from that policy. And that's how you get a sense of roughly what that coverage is actually going to look like for this client. So then simply put,
Right.
then for this policy, how much are you going to be paying in if it's a traditional, like we account for how many months you'll be paying this premium up until your predicted care date, and how much would that policy pay out over your long-term care needs. And that's how we get ROI. We took it a step further where
Could
we
you
know.
make on that prior screen, can you make the fonts bigger just for clarity's sake on the screen, or can you not do that? Can you hit control and then use the scroll bar? Does your allow it to occupy more of the, yeah, there you go. On the next page, yep, because I'm just saying that when you get to those bottom conclusions there on the right
Mhm.
panel, yes, so you're basically saying that using that particular policy, and I'm just doing this for the viewers, I understand where you're trying to go, which is that you've made some projections at these different phases. We've got policy X. Now, how are they going to match up under your predictive model given
Mhm.
the individual's data at those
Mhm.
different phases,
Yep,
basically? And from there, you're getting your conclusions, which is the next screen, if I read it correctly.
that is
If you
correct.
would go there. Right. I told Jane before we collaborated, I was already on board with pretty much where I thought that she was going to go, and so I'm just digging in and I'm doing some of the lifting for you here, Lily, in terms of
Mhm.
being the shepherd of what I'm sure you're would do better job than I. So talk to me about what you're defining as return on investment, because ultimately the issue here for everyday people is going to be that's fine. I can understand what the point is. The question here then is how am I thinking about whether that's a good allocation or not? Because you're squeezing liquidity, and everyday people who like don't have their radar turned on will say, well, I'm not going to spend $2,000, a month for long-term care because I want to punt it away on Nvidia. You see what I'm saying? And they think that
Yep.
that return is going to be better in some way. Forget about event risk or all the other, statistical biases, etc. But how are you measuring or communicating what you're saying the ROI is here?
Yeah, I wonder if I should even explain like the equation per se versus just like sharing conceptually with this like audience. It's a matter of how efficient is your money. It's like, is it better to put your money into a long-term care policy, or is it better to put your money into Nvidia, for example, because you think that that's going to pay out, that's going to have a higher, it's going to give you more money by the time you need care at age 83. That's essentially what we're doing with ROI. Is it just it's essentially a ratio of your payout kind of like essentially divided by the cost. Like, what is your investment into that strategy? Policies being one strategy, investments being another strategy. That actually speaks to here on this screen, which we added in a policy here, but now we're going to add in savings. So we account for, okay, well, you want to make assumption on it's coming from a brokerage account, and maybe there's still money you're setting aside, or you're not. And you think that that's going to perform at, a ARR. Let's just say it's going to perform 6.5% in the market, but you have to account for a tax rate, on the gains. And we accounted for, which we're moving a little quickly, also any social security income you want to add. So we blended, your kind of assumption on like, oh, I could pay for long-term care myself. Great. Let's go ahead and like learn what your assumptions are. If you think $500,000 to start, growing at 6%, and then you have some social security inside, is that going to be enough? And so that's what we model here. Similarly on ROI, and at least in this particular case, this self-funding method of like putting in $100,000, growing at 6%, removing sort of that tax rate, We get a payout of over $500,000, but more importantly, is it looks like it's more efficient use of your money than to put that into that policy, for example. So I'm just kind of sharing that as an example here. So the frustrating thing that I kept seeing in the industry is like when we designed this, we just thought that the policy side of our world was already a very efficient market and a very effective market, meaning they know how to pull the exact quote, an exact product that is the best for you and your situation, especially if they knew about it. But what I found instead, and Jay, maybe you could speak to this, is that it's without any AI, without any tools, it's really, really hard to and without spending hours on a spreadsheet, it's really hard to understand, the policy that was, essentially being offered at hand because there's a lot of fine print there. And so a lot of the policies that were getting uploaded into our system sometimes were actually more inefficient than your self-funding assumptions. And so that's where what we did instead is we created a very efficient market here, which is instead of manually
Well,
grabbing, we have
you've
analyzed.
created an efficient market in terms of trying to compare, using the metric that people are used to, right?
Mhm.
Meaning that your ROI is kind of based off traditional thought about the way that someone thinks about return on investment if they bought, shares of SPY and shares of, egg, right? And now
Yes.
you've got your 6.5, you're comparing using that metric without volatility adjustment, without other nerdy stuff that have to do with insurance.
Mhm.
Let me ask you about the following. So I'm going to ask you a very technical question.
Yes.
So now, today, right, the market that exists for the real world is generally an IUL with accelerated benefits, right? I mean, in
Mhm.
other words, overgeneralizing, I realize, right? I made this statement during the last meeting, that I spoke about the Alliance for Lifetime Income, which is that the traditional long-term care insurance market still doesn't have the population of number of sellers to be, from a
Mhm.
microeconomic point of view, pure competition, right? You can't have pure competition if there are 3 sellers, for example. You see what I mean? IUL has 50 sellers, so so
Yep.
more likely to be. But the tail risk there, and my question is, how have you built and dealt with it, is that you don't have GUL, which is guaranteed for people who are not familiar with the lingo, that's guaranteed universal life. You have IUL for the most part, which is still exposure to financial markets, right? To
Mhm.
some degree, right? In other words, you can have the situation where the cash value runs out and
Mhm.
you've put this money into IUL, right? So in other words, you are have this extra exposure to equity risk in IUL that people do or do not realize. And now the point of it, which I still support, don't get me wrong, I still think it's worth the thought about, okay, I need to accelerate this stuff. I'm taking this extra risk in equity. If they know about it, that's a lot different than not knowing about it. What
Mhm.
I'm concerned about, to be very candid, and you're not a broker of, or you have ability to distribute, but what am I saying is that I would be fascinated to hear what you have to say about that, right? Because IUL today and the way it's sold, right,
Yep.
has this idea of, you get this growth because you've got all these, 75 different indices of, but still ultimately exposed to financial markets. And if you
Mhm.
break down the correlation, and equity markets go, so first of all, the correlation of equity markets, so now diversification doesn't work, the efficient frontier
Mhm.
fails. At that
Mhm.
same time, your IUL then runs out,
Mhm.
right? Now you're 79, you're not to 83,
Mhm.
right? In which case, now what are we going to do? Is this, or is
Yep.
that kind of like the learning here, or et cetera, et cetera? And
So.
We haven't
Yeah.
discussed any of where, I know I'm blindsiding you. We haven't discussed the nitty gritty about what I was going to ask you.
Let's
So
actually dive into this. So, with these variety of products, I think what's actually really important to realize, other than what is a pool of money that you get to work with initially, and what it like, is, the mechanisms that kind of result in what is the end pool of money at a certain age. The key thing that you're mentioning here in terms of index or guaranteed is really what is the inflation protection on these policies, because that is usually like if you have an inflation protection of, like, let's just say you get your initial pool of benefits is like $500,000, and to make it simple, you have a 3% inflation protection. That means like that base amount of money is growing at 3% year over year. Usually, if you do compound, you could also do it simple. And with the index, you can actually model that in our system. It's just that you have to make the assumption yourself on what essentially is at inflation, essentially on that base value. So for us, I don't have an answer of like it's always going to be IULs like all the way, or it's going to be guaranteed all the way. I actually am very much Switzerland on this topic, because I think that that's like one aspect out of like 15 other aspects that actually matter when you think about any investment strategy here, which is why, in other words, I just simplify. It's just, you could add the funding, you could add the IUL with that long-term care rider, or a guaranteed with a long-term care rider, or a traditional policy, or even an annuity, even a standard annuity. If it has, if it pays double or triple, the income, if you have a long-term care event, there are
sure.
there are products like that. And then there's self-funding, which is, you take on the full risk because you think that your assets will grow healthily enough over time. I don't care what strategy you choose. All I care about is you just add that. You click on this button that is add funding, and you tell us what those assumptions are. Policies are way too complex for you to understand manually, which is why we built out AI that scrapes, all the text and all the, language in that policy, and we do the modeling for you. We grab the 15 to 20 terms that matter financially, and then we model it to, Jane or James in this case, like predicted long-term care scenario, to see, well, how do they work with each other? If James had this event and the policy covers, all these different scenarios, well, James has this particular scenario. So tell me, how is it going to pay out? So all I care about is we can now actually, for the first time in our system, compare apples to apples any investment strategy you want to add in, whether it's like your assumptions on an IUL, a guaranteed, self-funding, annuities, and you'll be able to see through ROI how efficient was that initial investment that you made into this kind of strategy or this product, if that answers your question.
it's close. It's very close. I mean, I have some other nuances, but I don't think that detracts away from your point, which is, the fact that you've built this model, which is a personalized one, which has some type of predictive power, calculative power. I'm not saying, voodoo. You're talking about predictive power to the likelihood of individualized need for long-term care services. And then from there, scanning kind of what financial contracts and how they would match up against your different phases. I think that alone, if that was our conversation and it stopped 15 minutes ago, I think that is just very, very invaluable. I mean, of course, this is, absolutely the message that I've used, on every aspect of having financial contract with whatever function it would be. I don't think there's any question. So now I guess before we get to a close, because we're running out of time, and I knew that we would use all the time. I knew it, which is that, what do you think the steps are here? Because one pushback and one set of objections is going to be similar, and I keep drawing the analogy back to annuity, which is that, what are your thoughts about what happens if broker, advisor, etc. becomes, do you sense the idea that people are going to be threatened by this, right? Because now you're talking about being taking away, and in annuities, there's a term called, I'm not sure if you're aware of it, called annuicide, right? Because of this idea that money putting into an annuity will take away from assets under management. In a similar way here, you have different payment structures for example, IUL can be 10 pay. There can be periodic where it's a modified endowment contract, et cetera. And so now you can have these different payment flows, which would also take money out of the amount used for the calculation of fees. So now my question is what do you think about that? Is this just inevitable? We've got lots of threats, right, candidly, on planners, financial advisory, financial guidance industries. Machines don't make mistakes that that people do. They don't have availability bias, and many other biases. What do you think? Your own opinion.
So it sounds like the question to me is, how do I view what we're building from the perspective of our existing advisors, as well as maybe new incoming advisors? Like, what does the future of this space sort of look like? Are we seen as competitive, or are we seen as synergistic? And so my answer is synergistic. We actually very intentionally designed our system to be synergistic, both from a business model standpoint, but also advisors are not having this conversation today, and it's putting hundreds of thousands of dollars on the line. That is the reality of where we're at. It's just they're too afraid of looking too dumb on a complex topic that they won't bring up the risk in a way that is actually solved for with a real, solution that they can understand. So they don't have the conversation unless, a client reactively goes to them. And unfortunately, even if the client goes to them in 90% of cases, there's not that many clients that go to them before it's too late. And so it has to be on the proactive part of the advisors about making them confident. So this tool is meant to make them confident, meant to make the conversation efficient, because they're going to be kind of, I would say, pressured with the advancing technologies. They're going to be pressured to differentiate themselves against these different technologies. Maybe they are the wrangler of all this technology. They know how to use it. They now have more functionality at their fingertips. I think that is what is exactly happening. We went from an investment-oriented space to one that is about financial planning. How can I learn more about your life? How can I understand different aspects of your life that have financial implications? So I think long-term care is the most significant risk in, when you retire, in terms of, the cost of it and paying out out of pocket. It's just the most significant risk that most folks would have to guess on without Waterlily. But now with Waterlily, you're removing that guesswork and actually protecting those assets if possible. And you're also having the tool that you also get the tool of ROI, which is how efficient is one strategy versus another strategy pretty immediately. With agencies, it's the same thing. I do think, though, that there's not that many advisors in this industry. If the question is, with the new generation, the younger folks coming in, how many of them are going to want to be a financial advisor, or are they going to get blocked out by all these advanced tools that will get closer and closer to the consumer? That is honestly for the consumer to decide. We have a very efficient market where I think that I think planners act more as an architect of all these different tools, and they wrangle them and they help have a more human conversation, and the client trusts them and their perspective and their expertise. I think that will continue. But for the new advisors coming in that have to learn all these concepts, how will they be able to? I do expect some sort of chasm in between for clients getting over the hump of trusting someone new, to the older advisors who may not have the time to train up the younger, newer generation to want to do this, and that might cause a bigger kind of demand from the market to be more D2C. Is like my initial thoughts.
Let's presume for a moment we don't get to utopia tomorrow, or when we post this video. How do people, viewers, everyday people, interested? They know that are the studies that we've run, the studies that we've presented, and we're not the only, right? Which is long-term care costs being a concern on the consumer side. That for whatever reason, I'm not sitting here judging what you've presented some possible reasons why this conversation doesn't occur, etc. We have the same thing about, okay, do you understand anything about the fact that your government debt shutdown is going to create health insurance premiums up by 20K? You don't have that conversation. That's taking $20,000 a year running NPV out of your portfolio, etc. We don't have a lot of these conversations, and very directly related to net worth. How do people get aware of your program and what it can do? Because my own view is that this is going to require the end around, actually. And I realize that it is most scalable to go to the wealth manager, right? Because they then have their client base. But the practical reality, the practical reality is that this conversation then is actually in real time comes from the buyer, meaning that the person whose sister's in-laws can't take care of themselves, and now the sister has to take care of the in-laws, and now you're the person whose sister you're watching. Now it raises the issue to you. You now then have the catalyst. You then ask your broker, tell me, my sister's going through this. She quit her job. She's got to take care of her in-laws who didn't raise her, and now now a lot of their money is going away. I'm watching this and I'm taking the phone call or, getting the text about it. Now I'm going to my advisor. So my question then is, I firmly believe that is actually the pathway of this conversation, right? For a while, unless we were able to click our heels like Dorothy, right? That you're going to require it come from the other end, the buyer. How do we get to the buyer? How have you, Waterlily created out to that? And that's how we'll close here today for you to tell us how we do that. And I told you, I'm happy to share whatever links you've got and material we've got, to publicize your platform. I knew already before we even hit go, this time is going to fly. We could double or triple this length easily.
Yeah. So the best way to find us is honestly waterlily.com. You could also follow us on the socials, because that is where we post our progress. We post where are we traveling. We post, what we're going to do next. And we post what have we already accomplished, so that you could start to understand, I'm not ready yet. Well, actually, I am ready now. I know that you now have this sort of functionality. And more importantly, you as to your point, the end buyer, the end person who takes on majority of the risk of long-term care cost and the care needs when we don't solve for them, the family. This is where, by following us and understanding what we do, you could start to familiarize yourself with the language. You could start to share with those around you that you feel like should be having this conversation with you. It is your primary care physician. It is the social worker that you worked with on this topic. It is, with, the area agency on aging that you called up, a government resource. It is a retirement community, asking them like, hey, I think you guys could do a lot better with having this conversation with me, because I think it's ultimately going to be on a professional as a mediator for variety of reasons, which you might already know, to help manage this conversation. It's a matter of giving them the tools to be able to have a conversation with the family members, and they get trained up on the tool, because they can, serve hundreds of thousands of families at any one time, as long as they're aware of, I would say the most impactful tools, for them that honestly just make their job easier. That's why we've optimized for them, but we are widening our aperture. Majority of the people that follow us right now, I believe, are consumers, and they're waiting for a consumer version as well of the system. And so I'm sure that there will probably be a hybrid, opportunity. One is get the professional to do the job for this shouldn't be on you, because other people have good, like, real financial incentives to help you on this topic. So I would say leverage other people if possible. But otherwise, for those that are like very motivated, they will try to get this D2C, and I don't think I would stop them that much.
Well, congratulations, Lily. This is a great platform. A very, very important topic, front of mind, increasingly so. We have no national long-term care strategy. That's clear. I was interviewed on this exact topic, you last year or a few months ago. And the fact that we've got this exciting new technology on such an important topic is awesome. And like I said, we could have had this double the length, triple the length, because I left out a lot of questions I want to ask, maybe for next time.
Absolutely. It was a pleasure talking to you, Jay.